Oh, welcome everybody. Once back again here on the webinar series about developing super trading strategies. My name, as always, Stefan Friedrichowski, and many thanks to Argus FX to have this kind of webinar series. They make it possible, and that's appreciated, absolutely. So the topics for today, by the way, we have the 20th of October, 2016, and you might hear that my voice sounds a little bit crazy. No, not really crazy, but please apologize. I have a little bit of cold, and even it might be that my voice goes down. I hope it will survive the next hour, and I have to apologize if I have to cough, that it might be a little bit noisy for you. I hope I can mute my microphone before doing that, but let's see. Hopefully everything goes well, and yeah, my voice will be as it is right now during the complete hour. The topics for today, yeah, once again, question and answers last week. It will be a little bit different because the one or the other might know that I have been last week on a so-called live trading week. Around different cities in Germany, Munich, Frankfurt, Düsseldorf, Hamburg, and Berlin. And I simply would like to share two things from those webinars with you under the topic question and answers last week. Then it has a little bit to do with what we talk about there, but I want to emphasize once again the importance of spreads and commission for trading. And I will illustrate it once again with an Excel sheet, which is quite easy, just to demonstrate the importance of the costs of trading. And this will then go further in, yeah, I call it a single line trading description, or the difficulty of trading in a single line. It's quite amazing that you can have just one line in an Excel sheet in order to demonstrate what is trading about and how to deal with your own trading activities versus trading profitability. So it is, for me at least, it is quite yeah, impressive to have it that way. But finally, once again, we want to talk about trading strategies. Today, a little bit different. Today, we will use a more discretionary approach. Discretionary means what normally every trader is doing, analyzing a chart, entering a trade, setting stop losses, setting take profits. But I will combine it a little bit with statistics and just two approaches how to find good trading, trend trading strategies. So all will be related about trends. And there are two easy ways to find those trends and to identify the best forex pair for a trend trading. So that's the topics for today. But let's start immediately. Yeah, last week experience from this live trading week, just two statements, because I simply want to share those with you, because I have met more than 100 people during this 1 week, and two statements here. I asked all the guys, yeah, what do you trade most? And there's a clear ranking about what they trade, and the number one, that might be related because all the cities have been in Germany. Most people trade the DAX. Second is the forex pair Euro US dollar, and the third one is gold. That is quite amazing for me always because if I look to the current chart situation of DAX and Euro US dollar, um, then this is not the best choice right now. Um, at least it depends a little bit on the time frame you trade, but if you are on a more daily based trading strategy, then at least the DAX and Euro US dollar are not very good for trading activities during the last year even. So that means for me, when you identify that DAX and Euro US dollar might not be the best, then look for other trading chances. Our trading universum is big enough that we find better underlyings to trade. And at least if you trade on a daily basis. Gold story is a little bit different. There have been some good signals within gold, but at least once again for the last couple of months, gold is not a good underlying as well. So it's crazy that people like most what I think is not the best to do right now, but it's interesting. And it means a little bit, yeah, all the people, they trade what they traded before and what they feel comfortable with, which is good, to trade those underlyings you feel comfortable with. But if they are not good right now, then it's maybe better to go away from those and look for other underlyings. Another statement which have been frequently mentioned within that week is that people regret that they don't have more time for trading. They do it, they do their analysis maybe on weekends and have the chance to enter trades early in the morning or in the evening because they simply go working. But they think that if they would have more time and they could trade on smaller time scales, then they automatically become more profitable. And that statement is simply wrong. And you will see during today's webinar that increasing trading activities that does not automatically enhance or increase your profitability. It might even be vice versa, that if you increase your trading activity, then your profitability goes south. And that is, or that has been one trigger for me to put that topic on the table once again, and that has especially to deal with spreads and commissions on the one hand, and trading activities in general on the other hand. But let's see. We made an experiment. We will make an experiment here, and the experiment is quite easy because we will have a crystal ball. That crystal ball will tell you the direction of the next candle. So we know at the beginning of a candle whether that candle will be a long candle or a short candle. Of course, I don't have such a crystal ball, but let's do this kind of experiment. So we know, for example, for a 1 minute candle, a 2 minute candle, 5 minutes, 10 minutes, 30 minutes, and 60 minutes, so 1 hour candle, we know the direction. We don't know, well, before we will not know how far that candle will go. But let's assume at least we know the direction. So if we know the direction is a long candle, then of course we will trade this as a long trade, and if we know that it will be a short candle, then of course we will trade it as a short candle, so we open a trade in the short direction. Does that now mean that we have automatically a brilliant performance? And you might imagine already the answer, and it's already written down here, and the answer is simply no. Even with such a crystal ball, we are not automatically able to have a good performance. And the simple reason is that we never have to forget spread and commissions, so that depends on the broker, and there's no principal difference between brokers who have both spreads. Every broker has spreads, not every broker has commissions, but you will realize if a broker has no commissions on trades, then they will have higher spreads. So it's finally more or less the same. Mathematically, it's not exactly the same, and trading-wise, once again, it's also not exactly the same, because lower spreads have other advantages, but that is a different topic. So let's go into an Excel sheet, and I can, with that crystal ball, let me describe first what I have done here, and therefore I zoom a little bit. And you see, if you look here for the time scale, I have data on a minute base, so M1 candles. Those candles, of course, have an open, high, low, and close. And what I now simply do, let's look here to the formula. You might try to figure out where is now the crystal ball. And the crystal ball is simply mathematically in the absolute value. So what I look here, and I press it, then it should be highlighted once again. What you see here, I calculate the difference from close value 1 minute later to the close value from my previous candle, and since I take the absolute value of this difference, that by the way means or that is a reason for having that crystal ball, because I even don't think about whether it is a long or short candle, or do I have to open a short trade or a long trade, because I take the absolute difference. It's always good for me, whatever change comes. But what you see here now, then there's a minus the value for the spread. And that spread value can be changed now, and I do the spread in bips, and because I take the spread in bips, I have to divide the spread for the euro-US dollar forex pair by 10,000. And that would be the trade result of a long or short trade, whatever is the right trade, for 1 minute. That's a simple calculation. What you see here, I have always to pay the spread, and that is taken into account. The difference here for the next column is simply that I look 2 minutes into the future, takes the difference for a 2-minute change, and do the same kind of calculation, 5-minute change, and so on and so on. So I have here all the trade results with a crystal ball, knowing which direction I should go for. You realize already here that there are trades which finally have a minus, and that even because of a crystal ball. But the simple reason is I have always to pay the spread. But now let's go here to the picture. And that is a result because I sum up all my trading results on those different timescales. That is done, by the way, here on the right of my Excel sheet. And what do we see now? I have data. I have took 100,000 M1 candles. That's not a very long time period. It's only a time period of, I think, 3 months, something like that. And now we have something like an equity curve within that graph. And you see the best results you will have if you go for 60-minute candles. And by the way, if you would go for longer, it would even go better. But what you see else is that if you decrease your candle time prediction, or the candle period, then your profitability goes dramatically down. Why? Now, what the main reason is that within 1 minute, there's not much time to have a change of the price, which is bigger than the spread. And let's see what happens. Right now, the spread is only 1 bip, which is principally okay. But let's see what happens if you go for 2 bips. You might say, okay, my broker has better spreads than 2 bips. But don't forget all those slippages, all those events around midnight. At least for 2 hours, you have even higher spreads than the value I have here. And that is absolutely typical for all brokers. And you see here that if you would have that crystal ball and you would have a spread of 2 bips, then for trading on M1 or M2 candles with that crystal ball, you have no profitability at all now. So you see that the equity lines go south. And that is quite astonishing, I think, because even that you have a crystal ball, you are not profitable. And that automatically tells you that if you go on shorter time periods, it's even harder to have good trading results. Because your trading frequency is that high that you are not able to at least re-earn the spread. And think about even my data are euro, US dollar, but let's think we have the same values in price here for British pound against Canadian dollar. Then you might even think about spreads which are like 4 bips. And that means now that only for candles predictions higher than 10 minutes, you become profitable. So if you would trade something with 4 bips spreads, then it's extremely hard to get profitable on short time periods. And remember, I know the direction of a candle before in this Excel sheet. I have this magic crystal ball. And even with that crystal ball, I'm not able to enter the profitable region. That's important that we always remember that statement. And that has to do with the right selection of forex pairs you trade, doing it on a right time scale, because you see here immediately if you do it wrong, then of course you go not profitable. And Still, there's a chance to trade the British pound against Canadian dollar on a 1 minute base, but not with this kind, let's call it strategy. It's not a real strategy, because at least what we have to do is we might enter trades on a M1 base, but still we take those trades, trade duration might be 2 hours, then there is at least a chance that we have enough movement to re-enter the profitable region. So it's only an illustration, but it should tell you, keep in mind, have a look on spreads, have a look on commissions. I don't have commissions here, that's the Excel sheet. I could do it as well, but if you just add those commissions as being spreads, then you would get the absolutely same results. That was the first statement now about always have a good look to spreads and commissions of your broker, because it's extremely important for your profitability. And now you know that if you go the time scale down, it is always harder to become profitable. Something which is more or less similar, but now we look more from a trading account perspective, that a real trading account perspective, and that means for me now that I will try to illustrate the difficulty of trading in a single line. And the result you will see, I wrote it down here already, you will not like it, that I know. And all we need just for that kind of consideration is we need a number for your account size in, for example, euros or US dollar, whatever currency you trade or your account is traded. Then we just need an estimation of what is your trading volume per day. Just think about, okay, typically I will enter 2 trades per day, and always with 0.01 lot. That might be something you have in mind, or just look to your own trading activities, then you will know that number. And the third input is simply the costs of trading. And costs of trading, 2 things, as always, spreads and commission. And what you will learn, or what that Excel sheet will tell you, what is your target profitability just to survive. So what finally means break even, that you trade and you don't lose money. So it's quite easy to do something like that. And the Excel sheet is that simple, and it's, let's say that now it has more than one line, but most of the lines are simply headlines. So the final calculation is done within that one line. Okay, let's go exactly through that sheet, because it's good if you understand how the calculation has been done. I have assumed you have an account size of 1,000 euro. And then you see it already underlined in yellow, that I can enter a number for lots per day. So that is my trading activity. Okay, I go back to my example I told before. I typically do 2 trades per day, both trades with 0.01 lot, which doesn't sound much, I know. And now, what have I done here? You see 2 other yellow fields within that Excel sheet. I have assumed that you have spreads of 1 bips and commissions of 1 bips. I can do it other way around, like having two bips spreads and zero commission or whatever combination. I don't care, but that is only for illustration, and you can play around. By the way, if you would like to have those Excel sheets or whatever sheets here, then just send me an email, and I will make those sheets for you available. So what I have calculated here is simply, let's have a look here, the monthly costs. And that is because I have calculated the lots per month simply by multiplying the lots per day with 22. That is a typical month that has 22 days of trading activities because of the weekends. So, and those are multiplied with the spread and the costs involved with the spread. So here we have €4.40 because we have 0.44 lots. And additionally, we have €4.40 commissions because per lot we have €10 commissions. This adds up to costs of €8.80. And now I have simply made two calculations. So what is the monthly target return value? So the percentage return you have to achieve in order to recover the costs of your trading. And you see it's nearly 1%, or talking about returns, it's easier to visualize or to figure out a yearly return value in percent, and that is close to 11%. Let's rethink about that. So we need, out of our trading activities, we need at least 11% yearly return in order to recover the costs of our trading activities. So that means now we are break even. We have not earned and we have not lost any money. And if you compare it with your own trading activities, and once again it's this €1,000 account, you just make 2 trades per day with 0.01 lot, and you have already to have strategies with or trading activities with a yearly target of 11%. I think that number is quite impressive. And think about somebody or even yourself that you trade 5 trades per day with 0.01 lot, then you would need already a 62% profitability in order to earn back your costs of trading. And you know, you can compare those numbers with typically returns, for example, of or interest rates, or you can compare that number with returns of companies, because a company has to have a return on investment or return on sales, however you calculate that number. And a typical already good company has a yearly return of 10%. And what we are doing here with trading is, if you have those 5 trades per day, you would need a profitability or a return value of a little bit more than 25%. So it's a high number, I know, and that is exactly what we are going for when we do those trading strategies. And the first is always to re-earn our costs of trading, and that this is hard already. That is exactly what I want to share with you with that simple calculation. And the story gets worse if we go upwards with those values, only to see the numbers, then you can see, well, it's not easy to get those numbers. Therefore, my statement is always, do not dream that trading is easy and trading automatically give you high return values. Those numbers should simply show you it's a hard job, and to have a profitability of 30% just to recover your cost of trading, yeah, should tell you a lot. Just a second. Sorry for the interruption. That was exactly that I have to cough, and yeah, hopefully it will not happen that much again, that often again. Good. Oh, my voice is going down. Let's go back to our presentation, because I promised that I want to share with you two approaches today for trend trading activities. Trend trading is, at least for my thinking, the most popular trading base strategy for all traders, and it's in principle a very good base strategy. Trend trading, of course, means, hey, you have to identify a trend for whatever underlying, and then you jump into that trend. And of course, what you always hope is that the trend continues, and you will earn money with that trend. Since I have done a lot of trend strategies, I know that the following statement is more or less in principle valid. And that means that trend trading always has low win rates, or in other words, you need high risk reward ratios, or for the German of you, that is what we call CFO. And that is a risk reward ratios. So the relationship between your potential take profit and your stop loss should be in the range of something like 3-1 at least, that you have 3 times higher profits than a typical loss. If you have this number, then you can calculate directly the win rate which is necessary for break even, and that is without costs, simply then a win rate better than 25%. And that is quite typical for all trend trading strategies, that you have high risk reward ratios in order to sometimes get those high profits, but you will always have low win rates. If that would be vice versa, then it would be very easy. In principle, my opinion about trend trading is that it's a good base strategy, and the reason from a more mathematical standpoint is that we know that underlyings are very close to a random behavior. We have had a webinar exactly only for that topic, this random walk-like behavior of all underlyings, and we found that all underlyings are very close to a random price behavior. Now, a trend is simply a strong deviation from that random behavior. And the statement, all deviations from random behavior can be traded, is valid. what we need is to identify that kind of deviation, because if we are not anymore in a random price behavior, then it will be possible to have good results with, for example, a trend trading approach. Because a trend, and the longer the trend will be, the more is that deviation from this random price behavior. And always, if we have not this random behavior, we can have profits. If everything would be random, it's impossible to generate profits. I think that has been shown in previous webinars already. And the two basic setups I will show you later directly in MT4 is in the German language. It's called EMA Fächer. I translate it to fan out, but sorry, I'm not sure whether that is the right translation. Let's describe exactly what I do, then I don't have to rely on this phrase fan out. What I use is several EMA indicators with different time periods, and what I take here is just a series of 20, 40, 80 and 160. You immediately identify what I have done here. I have simply multiplied all, starting with 20 and then multiply always with 2. And the basic element of the trading strategy is that if those EMA lines come together, if they constrict, then it's a good chance for jumping into the trend. If you compare and if you think about this basic signal for entering a trade, then it's a little bit like if you do market analysis with prices and you have always this 1, 2, 3 behavior going up, going a little bit down, going once again further up, going a little bit down, and so on. So you have, I don't know, you know this typical behavior. And if you have 4 EMA values in those in this typical behavior, then you will see that immediately when the correction of the price comes to an end, then the EMA values will come together. That is one approach. And the other approach, we discuss later. Let's start with the first one here. And let's have a look on how I do it. I will enlarge one chart first here in order that you see what I have done. We have here euro against Australian dollar on an H1 timescale, and you see that I have those 4 EMA indicators within my chart. And I know that this one here is not, by the way, the best example, but let's focus first on the behavior from here onwards. And then you see exactly what I mean with those 4 EMAs come together, then they fan out, they come together once again, and so on and so on. Right now, it might be that they come together once again, and you see that when those 4 EMA values come together, exactly then is a good point in time to jump into the trend. if you look, for example, here in that area, okay, entering here a short position finally would have been a good idea. You see that. But the better entry is a little bit higher. And this is automatically shown by this constriction of the 4 EMA lines. And that means we can use that setup here to identify those trend behaviors. Think about here in this case, oh, so that's too big. Let's take this one. Right now, there might be a reversal, so a change in the overall trend. But look before, we have always the same behavior. Up and down, and from time to time, those 4 EMA indicators come together, and always that would have been a good opportunity to enter a trade. Right now, I would do nothing, even if those come together once again here, because first I want to wait whether we will have a fundamental change in the overall trend from upwards to downwards. But let's see. So I would not take this example right now, but I want to have one more example here, Euro US dollar, because it shows you once again this very nice behavior with the 4 EMA values, and now the trend is already extremely strong. And to enter a new trade into the short direction in Euro US dollar, we would simply have to wait until they come together once again. But whenever that will be, I don't know. Sorry, now I have not mute my microphone. Hopefully the next time it will work. Let's have a look. You see what I have done, by the way. This is MT4, and I always create those so-called profiles, and that means you create a general chart on your screen with, for example, those 6 forex pairs, and the reason for those 6 will come with the next strategy. And then what you arrange everything like you want to have it, and whenever you are finished, then you can store this profile and giving it a name. And you see I have a lot of names already for some profiles, and that means afterwards I can immediately switch very easy from one profile to the next one. For example, I have another profile here which is the same charts, but only on M5 base, 5-minute candles, and that what you realize here, if you have once trained your eye to that kind of chart, let's call it chart formation, or this EMA fan out, yeah, then you can very easy realize is there a new trading chance, yes or no? And by the way, if we would have done the webinar a few minutes earlier, for example here, then there's a very good new chance. Right now, unfortunately, the price is already here down, so it's a little bit too late to jump into that scenario. So, but anyhow, that is the way of, or the principal approach using 4 EMAs to enter trades. Just one remark on that. It's related to another strategy, which is called a rainbow strategy. The difference is not very big. It's only the number of different EMA values and the coloring of the different EMAs. If you have more EMA values and you color those EMAs not in red, like here in my example, you color those EMAs like the rainbow itself, then you have the rainbow strategy for trend trading. So that is one good principal approach to come into trends, looking for those 4 EMA values. And another way to have a good approach is what I call the lead lag approach for Forex. And how does that approach work? The first is that you don't look for all the Forex pairs you have in mind. So in my case, I don't look for US dollar versus Japanese yen. And I have no chart with British pound against US dollar. No, what I do is I look for 6 charts. And those 6 charts are generated by the combination of euro against, and now I have 6 other currencies: Australian dollar, Canadian dollar, Swiss francs, British pound, Japanese yen, and US dollar. By the way, the list of those 7 currencies is easy developed. It's simply taken from the Wikipedia article about Forex, because those 7 currencies have the highest revenues in the world. So they are traded the most. There's one currency missing, the Chinese currency, but still I think that currency is not free enough to trade, therefore it's not listed here in my list. So you have the most important 7 currencies of the world here, and by the way, the US dollar is the most traded one at all, followed by euro, and then I think it's British pound, Japanese yen, and then I can't remember. And in order to identify finally that Forex pair with the strongest trend at all is quite easy. Because the only thing we have to do is we have to look for those 6 charts, 6 combinations, euro against the 6 other ones. And we have to look for and you have to look for the strongest and for the weakest. So that is exactly what you have to do. Identifying the strongest and identifying the weakest. And that is extremely easy. Let's have a look to once again to my MT4, and I go to another profile, and let's start with D1. And you see I have here once again those 6 Forex pairs: euro, Australian dollar, Canadian dollar, and so on and so on. And I put in just one EMA value, just a moving average with 200. And just looking here, I can see just within milliseconds more or less, I can identify the strongest and the weakest. Strong, I simply mean trend upwards, and weak, I mean trend downwards. And the strongest is euro against British pound, and the weakest would be euro against Japanese yen. And now the trick is that easy. The combination of Japanese yen against British pound will have or has the strongest trend at all. The only thing is I have to do now is to look how that currency pair is really called. And in this case, it would be called British pound against Japanese yen. And then I open a chart in that currency for this forex pair. D1 once again, and yeah, that is now the forex pair. Let's do it a little bit smaller, and now I have identified the one with the strongest trend of all the possible 21 combinations of those 7 base currencies, and this is the one with the strongest trend behavior. And remember, why do I look for strongest trend behavior? Because that kind of behavior is a deviation of the random walk. So trading now British pound against Japanese yen brings me already on the edge, brings me a probability advantage, or so-called edge, that I don't have to fear the random behavior. It's absolutely no guarantee that not from tomorrow onwards it will re-enter this random behavior. I don't know. But at least what I know is that for the past couple of months, this forex pair has been the one with the strongest trend. And this can be done on other time frames as well. Let's directly jump into a smaller one like H1. And once again, you see with just a single view to identify the strongest and the weakest. And I like that example here because thinking mathematically about all these possibilities, then of course it is possible, like here, that all euros against the other ones go south, or all go north. In this case, the strongest, or I have only to look for the weakest in this case, because everything goes south here. Then I look for the weakest, and that would be euro US dollar. So my trading possibility is now a short trade in euro US dollar. Let's have a third example that you can realize that this is really good for all time frames. Now I'm on M5 time frame. And here, of course, I can have a look once again to the strongest and the weakest. So the strongest in this case is euro Australian dollar, and the weakest is euro against Swiss franc. And then we have identified our trading possibility. So it would be Australian dollar against Swiss franc, and we open a new chart here, and now we can try to find a trading possibility within the chart. And this, because as in the introduction I called it simply a discretionary trading possibility. What I could do here, for example, okay, I can say I like the trend is already quite in progress. I would like to have a re-entry that the price first goes a little bit up and then continues with a trend. So I could enter here, for example, a trade like lead leg. M5, and this would be a sell limit order on the level 0.75796, and maybe a stop loss a little bit higher, let's say 0.7592. Oops. 7592, and take profit we have to define later, but I want to have already one number within the chart here, 75, and then I can jump into that kind of trade. And you see now within the chart the trade. And remember that I told you we need at least something like 1 to 3 between stop loss and take profit. So it might look like this one here. Let me go a little bit out. Yeah, that's okay. And now I can place an order like here. A remark to just placing orders here. Those kind of activities I always do in a demo account first, especially if I do it here within that webinar, because it might be that I do some mistakes here, and therefore, I simply do it only in demo accounts. But remember how easy it is to identify trends, trend strengths of 21 forex pairs, just looking to those 6 pairs, because by looking to those 6, you are able to identify the strongest trend behavior for all combinations, which are 21 in this case. And you don't have to look to all the charts individually. You do the identification process with those 6, and then you know which one has the best trend behavior. And yeah, it's that easy. Well, my voice has survived 1 hour, which luckily is okay. I think still you can hear me at least good enough. But once again, thank you very much for being here within that webinar series, developing superb trading strategies. Today it was not a rule-based strategy like other ones with strict rules. We have discussed 2 strategies from a more discretionary point of view, just looking for opportunities, and trades would be entered discretionary in this case. But next week we come back to the complete rule-based strategies, and hopefully you come here once again. If there are any questions, just send me an email. You are always welcome to get in touch with me, and for me it's a pleasure to get in touch with you as well. Okay, thank you very much, and have a good day. Bye-bye.